Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're looking at Portillos.
If you find our talks useful, please consider subscribe, like, and comment underneath. So imagine a restaurant chain where fewer people are walking through the doors, right?
Yeah, never good start.
Exactly. Operating costs are creeping up, and Wall Street analysts are just openly sweating about the macro environment.
Oh, they're panicking.
Right, they really are. Naturally, if you glance at the chart, you'd think this stock is essentially dead money, just, left to languish at its 52-week low.
Well, yeah, that's what the algorithms are telling you.
But what if I told you that right in the middle of all that negativity, a highly respected industry veteran just walked in, looked at the books, and essentially bet $1.5 million of his own personal cash that everyone else on the street is dead wrong?
I mean, that's the ultimate signal through the noise, isn't it?
It really is.
When you strip away the daily market panic, what we're actually looking at today is a massive, high-stakes tug of war.
Okay, the tug of war. Break that down for me.
So on one side, you have these very real, very loud short-term headwinds that have retail investors completely spooked.
Right.
But pulling aggressively on the other side of the rope, you've got some massive long-term growth signals. It is a classic contrarian setup.
I love a good contrarian setup, especially when there's serious cash on the table.
Exactly. So we are going to tear down the financials, look at this incredibly unique brand moat, and most importantly, we'll map out the specific dates and catalysts you need to watch.
Because we want to know if this $1 million insider bet is going to trigger a massive valuation re-rating, right?
You hit the nail on the head. To understand why the market is so incredibly divided on how to value this company, we really have to open up the hood on their Q4 2025 performance.
Yeah, let's look at the numbers, because they tell a story of a company fighting a really tough environment, but, well, fighting it incredibly well, I think.
They absolutely are. So their top-line revenue came in at $185.7 million.
Which, to be fair, that is only a 0.6% increase year over year.
Right, it met analyst estimates, so nobody is, popping champagne over explosive revenue growth.
No, definitely not. But the operational control they displayed underneath that flat revenue, that is what caught my eye.
Oh, for sure.
Because they reported a GAAP earnings per share of 8 cents.
Which is a number that, well, it forces you to sit up and pay attention when you look at the broader context.
Yeah, and for anyone newer to diving into earnings reports, GAAP stands for Generally Accepted Accounting Principles.
Right, the strict stuff.
Exactly. It is the strictest, most conservative, by-the-books way a company can report its profits. No clever accounting tricks allowed.
And Wall Street analysts, looking at this tough economic environment, they predicted Portillo's would only squeeze out 5 cents a share.
Wow, so coming in at 8 cents means they crushed the consensus estimate by over 74%.
Yeah, massive beat. And alongside that, they managed to pull in a positive net income of $6.3 million.
So squeezing significantly more profit out of essentially flat revenue, I mean, it means management is aggressively playing defense.
Oh, absolutely. They are finding efficiencies, they're cutting the fat, and navigating cost pressures in ways the broader market simply hadn't priced into the stock.
But, to be fair to the other side of this tug of war, the bears do have some very loud arguments right now.
They do, yeah. We can't ignore them.
The big red flashing light that has everyone running for the exits is the same restaurant sales metric. It decreased by 3.3%.
Yeah, that's a tough pill to swallow.
And if you follow the restaurant sector, you know that negative foot traffic in existing stores is, well, it's the #1 thing that gives investors heartburn.
It is the ultimate metric of a brand's current momentum, period.
Right.
And when you pair that 3.3% drop in same-store sales with what happened to their margins, you see exactly why the stock was pushed down to its 52-week low.
The margins took a hit, too.
Yeah, their operating margins shrank by almost 2%, or 190 basis points, if we're using Wall Street terminology.
Or dropping from 7.5% down to 5.6%.
Exactly. And this is just the raw mechanism of a challenging consumer environment at work. People are feeling the pinch of inflation, so they go out to eat a little less often.
And at the exact same time, the cost of beef, the cost of labor, the cost of simply keeping the lights on in the restaurant is going up.
Right. So that dynamic eats the profit margin from both ends. So, the algorithms and the momentum traders see shrinking traffic and shrinking margins, and they just blindly hit the sell button.
Which is the natural reaction for a lot of companies facing that kind of Margin pressure, right? Just hunker down, freeze all spending, and weather the storm.
Usually, yes.
But Portillo's doing the exact opposite. They are actively trying to pivot away from being a slow, mature market story and transform into an aggressive growth story.
Yeah, it's a bold move.
Over the past year, they expanded their footprint, growing from 94 locations to 102 locations. And looking ahead to 2026, they already have 8 more new units on the drawing board.
And this unit expansion is the core engine they are using to offset that macro-induced traffic softness. But the most vital piece of this puzzle, the thing that separates a sustainable growth strategy from a company just, recklessly digging a deeper hole, is how they are paying for these new restaurants.
Which is huge right now.
Exactly. They are not funding this expansion by taking out massive loans. This growth is largely self-funded.
Wow.
Yeah, in the fourth quarter alone, they generated $40.6 million in restaurant-level EBITDA and $24.7 million in adjusted EBITDA.
Let's break down that EBITDA acronym for a second because it's crucial here.
Sure.
Earnings before interest, taxes, depreciation, and amortization. Basically, it's the raw cash the restaurants are generating from selling food before the corporate accountants and the government take their slice.
Spot on. Generating that kind of raw cash flow provides the capital to physically build those 8 new units in 2026 without relying on excessive external financing.
Which is everything right now. Think about the current economic reality. We are sitting in a high interest rate environment. Debt is incredibly expensive.
Oh, prohibitively expensive for a lot of brands.
For competitors who have to go to a bank and borrow money at 8 or 9% to open a new location, growth just becomes mathematically impossible.
Right. So self-funding your growth using the cash generated from your own restaurants is a massive competitive shield.
Okay, I hear the numbers, and avoiding high-interest debt is definitely a superpower right now.
Yeah.
But I have to play devil's advocate and push back on the core strategy here.
Go for it.
Listen, if a store is losing foot traffic, trying to fix your overall revenue by simply building another store feels inherently risky.
I see where you're going.
It's like having a bucket with a hole in the bottom, and instead of patching the hole, you just go out and buy a second leaky bucket to catch more water.
That's a great analogy.
Aren't they just masking the 3.3% drop in same-store sales by aggressively opening new doors? I mean, doesn't this expansion risk becoming a total drag on cash flow if the consumer discretionary environment weakens even further?
Look, if the new buckets start leaking just as fast as the old ones, you are absolutely in trouble. That is the exact thesis of the short sellers betting against this stock.
Right.
To figure out if this aggressive growth is sustainable or just a disaster waiting to happen, we have to look past the spreadsheets and look at the actual physical product.
The food.
Yeah, we need to define their brand moat. Because to survive a pullback in consumer spending, you need to be selling something people fundamentally refuse to give up.
And they aren't just selling a generic frozen patty that's been sitting under a heat lamp.
Not at all. Their entire identity is built around a hyper-specific Chicago-style menu.
Oh, yeah.
We're talking Italian beef sandwiches that are slow-roasted and dipped, authentic Chicago-style hot dogs, chocolate cake shakes.
Making me hungry.
Right. These are complex, high-quality items that are remarkably difficult for generic, fast, casual competitors to replicate at any kind of scale.
Yeah.
You can't just automate an Italian beef sandwich.
No, you really can't.
And because of this distinct, highly guarded identity, they benefit from a truly cult-like brand loyalty. And that loyalty translates directly to the balance sheet. It allows them to command a premium average check size.
Meaning they're charging more than traditional drive-through fast food, but the consumer is happily willing to pay that premium.
Exactly. It creates a highly strategic positioning in the market that industry analysts have actually started calling modern fast food.
Okay, modern fast food.
Yeah, it is this perfect, lucrative middle ground between the cheap drive-through window and the expensive, sit-down, full-service restaurant.
Interesting.
If you think about the psychology of the middle-class consumer right now, they are feeling incredibly squeezed by inflation.
Oh, absolutely. Everyone is.
They want to go out on a Friday night, they want to treat their family, but they look at their wallet and realize they simply cannot justify an $80 or $100 bill at a full-service sit-down restaurant anymore.
Right, it's just too much.
So they engage in a behavior called trading down.
But trading down doesn't mean giving up entirely. They still want the evening to feel like a treat.
Exactly.
They don't want to feel like they're punishing themselves by settling for a sad, flattened drive-through burger in a paper wrapper.
And that is the exact psychological sweet spot Portillo's captures. They offer an atmosphere, an experience, and a food quality that retains a strong perception of high value.
So even though the consumer is technically trading down to save money, they don't feel cheap doing it.
Right. This modern fast food positioning acts as a massive shock absorber against economic headwinds.
I see.
They might lose a few lower-income customers to the cheapest fast food options, but they are constantly catching the middle-income customers falling out of the tier above them.
Okay, I completely grasp the power of that middle ground positioning, and I know the cult loyalty in Chicago is absolute. People are fiercely protective of the brand there.
Oh, they love it.
But here is the major geographic tension. Does the magic of a dipped Italian beef sandwich translate well enough across the rest of the country to support this aggressive nationwide rollout?
That's the million-dollar question.
Right, like can you take a Chicago staple and make it a massive hit in Texas or Florida? Cult brands are notoriously difficult to export outside of their home territory because you are trying to manufacture nostalgia from scratch.
You're totally right. Taking a hyper-regional moat and scaling it nationally is arguably the hardest maneuver in the restaurant business.
It has to be.
You cannot just drop an Italian beef stand in a completely new state, unlock the doors, and expect automatic lines around the block.
No, it doesn't work like that.
It requires world-class real estate selection, incredibly complex supply chain logistics to maintain the food quality, and laser-focused brand marketing.
Which perfectly explains the dramatic corporate shakeup we saw play out recently.
Exactly.
The company realized that to execute this 8-unit expansion properly, they needed to bring in heavy artillery.
They did. The timeline of events in mid-March is a wild ride of shifting sentiment. Let's walk through it because it really illustrates how fast the narrative can flip.
Okay, let's do it.
Go back to March 12th. The bears are in full control of the stock. News is circulating, highlighting those deteriorating same-store sales we talked about.
Right, the 3.3% drop.
Fast forward a couple of weeks to March 25th, and you have major analysts publishing macro caution reports, sounding the alarm on weak foot traffic across the entire sector and highlighting the margin pressures. The stock is getting hammered.
Yet, nestled right in the middle of all that deafening bearish noise, the company quietly made some of the most aggressive, forward-looking moves in its history.
Yeah, they didn't just sit still.
They announced the appointment of Jennifer Pecoraro-Streepling as their new Chief Development Officer.
Right.
Her explicit mandate is to lead the brand's next phase of strategic development, handling exactly the kind of complex real estate and supply chain logistics required to scale a cult brand nationally.
And bringing in a dedicated chief development officer immediately sparked a wave of rumors. The market started anticipating that maybe they are looking at accelerated franchising models in these new states, or even exploring strategic partnerships to help shoulder the expansion costs.
It signaled to Wall Street that management wasn't just hiding under their desks playing defense. They were actively drafting blueprints for a geographic rollout.
And they followed that up with another massive leadership injection, appointing Eugene Eiley Jr. as chairman of the board.
Okay, tell me about him.
This is a heavyweight, battle-tested industry veteran. Adding someone of his caliber brings immediate, undeniable credibility to the board's oversight of this expansion plan. He knows exactly what pitfalls to avoid when scaling a restaurant concept.
Which brings us to the ultimate catalyst. The specific event that made us flag this stock for our talk today.
Yes, the big one.
On March 18th, right as the stock was bleeding out, sitting in the basement at its 52-week low, the newly appointed chairman, Eugene Eiley Jr., executed what is known in the industry as a cluster buy.
He went directly into the open market and purchased 286,000 shares of the company,
putting approximately $1.48 million of his own capital on the line.
his own cash.
Let's just pause and absorb the scale of that move.
Get a massive.
That is not an executive dipping a toe in the water to test the temperature or buying a few shares to show polite solidarity with the company.
No.
That is an industry veteran doing a $1.5 million cannonball into the deep end at the absolute lowest point of the stock's year.
Exactly.
It is a massive, blinding, contrarian flare shot up for the entire market to see. Insiders might sell stock for 100 different reasons, buying a house, paying taxes, diversifying.
Sure.
But insiders only buy stock in the open market for one reason. They're absolutely convinced the price is going to go up.
It is the ultimate leading indicator. An insider purchase of this magnitude, particularly from a chairman who has full visibility into the company's internal financials and strategic roadmap, it represents a staggering level of conviction. He is looking at the exact same macro environment, and the exact same 3.3% drop in same-store sales that terrified the analysts. And his conclusion is that the market has fundamentally, irrationally undervalued the company's assets and its cash flow potential.
Right. And when someone with that much inside knowledge throws down $1.5 million against the prevailing narrative, the market has no choice but to pay attention.
Not at all.
And we saw the mechanics of that play out almost instantly on the charts.
We did. From a purely technical perspective, that high-conviction buy triggered an immediate reaction known as a short covering rally.
Okay, a short covering rally.
Yeah, the stock jumped 2.7% almost overnight.
Wow.
Think of a short covering rally, like a high-stakes game of musical chairs. You have all these bearish investors who have borrowed and sold the stock, betting the price will keep falling.
Right.
Suddenly, a massive bullish signal drops, panic sets in. Those short sellers realize the music is about to stop, and they have to aggressively buy shares to cover their losing bets before the price skyrockets.
And this forced buying ironically pushes the stock price up even higher.
Exactly. When you see a stock aggressively reject lower prices following a massive insider buy at a 52-week low, it strongly indicates that the selling pressure has exhausted itself. The technical chart suggests a reversal, basically a solid floor, is actively forming.
So we've unpacked the setup. We have the fundamental cash flow, the highly defensive modern fast food moat, and the undeniable signal of a massive insider buy.
Yep.
If you're watching this stock from the sidelines, trying to determine if this contrarian thesis actually has legs, what is the wealth-building horizon here? When should you expect to see real movement?
So based on the synthesis of all these signals, the overall investment thesis scores a 7 out of 10, placing it solidly in bullish territory.
7 out of 10, okay.
However, it is vital to manage expectations. This is not a day trade or a quick flip. We are classifying this as a medium-term hold.
So what time frame are we talking?
You are looking at a 6 to 12-month horizon to really unlock a significant valuation re-rating. You have to give the new leadership team the actual time required to let their strategies take root and show up on the quarterly balance sheet.
Patience is the name of the game with value investing. So let's map out the specific calendar. What are the key catalysts we need to be watching for?
The first major hurdle is the Q1 2026 earnings release, which is expected to drop in late May of 2026.
Late May, okay.
This is the big one for institutional investors. What you need to look for here isn't necessarily explosive double-digit growth. You are simply looking for stabilization.
We just need to see that the bleeding has stopped.
Exactly. If that negative 3.3% same-store sales metric just flattens out to zero or even shows a fractional improvement, the market will react incredibly positively because it signals the worst is over.
Right.
Furthermore, you need management to get on that earnings call and confidently confirm that those 8 new unit openings are on track, on schedule, and on budget.
So if step 1 in late May is just proving they've stopped the bleeding on the balance sheet, step 2 has to be proving this new leadership team isn't just window dressing.
Precisely.
We need to see actual blueprints from the new Chief Development Officer.
That is catalyst number 2. You want to watch the news wires for official strategic announcements from Jennifer Pecoraro-Stripling.
What should we be looking for specifically?
Look for concrete specifics regarding new market penetration, major real estate acquisitions, or the official rollout of any franchising partnerships.
Right.
When the company transitions from speculative rumors to laying out a concrete, step-by-step roadmap for geographic expansion, it will validate the optimism that drove the insider buying in mid-March.
And the third catalyst is something we are actually already watching play out in the broader global economy. We're talking about macro tailwinds, specifically the price of commodities.
Yes. On March 17th, the broader restaurant sector actually experienced a significant, unexpected rally, and Portillo's skyrocketed right alongside its peers.
Oh, interesting.
The primary driver for that sector-wide jump was a sudden drop in crude oil prices.
Because in the restaurant business, cheaper oil eventually translates to cheaper logistics. It costs less to truck those Italian beefs across the country.
Exactly. It acts as a massive relief valve for input cost worries across the board. If we continue to see declines in the price of crude oil coupled with drops in raw food commodity prices, that is going to directly benefit their bottom line.
The margins again.
Right. Remember that 190 basis point operating margin compression we discussed at the very beginning, the 2% drop in pure profit.
Yeah.
Lower commodity costs and cheaper transportation are the exact mechanical forces needed to reverse that compression and widen their profit margins back out to historic levels.
I track the math on that, but it brings me back to a critical tension regarding the consumer.
Okay, let's hear it.
If commodity prices keep dropping, that clearly eases the cost of doing business, which is fantastic for the margin.
Yeah.
But if the middle class continues to tighten their belt at the exact same time, if inflation keeps squeezing the consumer's wallet, who ultimately wins that tug of war? Can cheaper ingredients and cheaper gas really save the restaurant's profit margin if foot traffic falls off a cliff?
That tension is the ultimate stress test of the entire modern fast food thesis.
Right.
If foot traffic plummets universally across the entire economy, nobody is fully immune.
Right.
But the core argument for this specific brand is their unique equilibrium. As economic pressure increases, they might lose a fraction of their highly price-sensitive, lower-income customers to the absolute cheapest drive thrusts.
Sure.
But simultaneously, they are continuously replacing them with higher-income customers who are trading down from expensive sit-down dining. They're looking for that premium experience without the premium price tag.
The shock absorber effect.
Exactly. If they can successfully maintain that equilibrium and keep the dining rooms full, those lower supply chain costs will drop straight to the bottom line, making them highly profitable even in a stagnant overall economy.
It all hinges on that brand moat holding strong and the consumer continuing to view a dipped beef sandwich as a worthwhile treat.
Synthesizing the entire picture, the risk-reward profile here appears heavily skewed to the upside for a patient investor.
Yeah, it really does.
Yes, the primary risk remains the persistent deterioration in same-restaurant sales. If they can't stabilize traffic, building new restaurants just accelerates the cash drain.
Leaky buckets.
Exactly. But the reality is that dire worst-case scenario seems largely priced into the stock already, given it has been beaten down to its 52-week low.
Right, the market has already punished them.
What the broader market is actively ignoring is the self-funded expansion runway, the protective nature of their modern fast food positioning, and the incredibly powerful signal sent by an industry veteran chairman committing nearly $1.5 million of his personal wealth to the company.
It's huge.
The algorithms are obsessed with the short-term bumps in the road, while the insiders are betting heavily on the long-term destination.
It is the classic disconnect between short-term fear and long-term vision that creates generational wealth opportunities. You know, looking at how perfectly positioned they are to capture that squeezed middle-class diner, it leaves me with a much larger question to ponder.
What's that?
If this current economic reality holds, and consumers permanently adjust their dining habits away from expensive sit-down meals, could hyper-regional cult brands with premium food quality eventually become the new national standards?
That's a fascinating thought.
Right. Could this Chicago staple be the exact blueprint that completely redefines what Americans consider to be fast food over the next decade? It is a fascinating shift in consumer behavior and definitely something to keep a close eye on as you watch those 8 new units open their doors.